Good afternoon, everyone, and welcome to GovCon 101 Cost Type Contracting. I'm PCI's John Plinky, joined today by our expert instructor, Bill Walter. Before we get started, I have a couple of housekeeping announcements. During the program today, I'm going to give out no passwords, so don't look out for the passwords. Today, we are just using the polls. So please answer the polls when they appear on your screen. If you can't interact with the polls for whatever reason, please put your answers in the chat. There's also a Q&A panel. You may also hit the raise hand button and I will turn control of your audio over to you so that you can ask your question to Bill aloud. We're probably going to hold all the questions to the end though, so be aware that it might be best to wait until the Q&A period at the end. Thank you all for joining us today. Take it away, Bill.
All right. Thank you, everybody. And thank you, John, for such a great introduction. Today, we're trying to compress what we talk about over 4 days into 1 hour session with 15 minutes at the end for Q&A and a couple of questions. We've got 4 or 5 questions we're going to ask after the training today to see either how well I'm teaching or how well you're listening. I'm not sure which way it's going to go, but we'll find out at the end. If you do really well, I'll take credit. So anyhow, today we're going to talk about cost type contracting. One of the elements of dealing with the federal government, contracting with the federal government, that is a kind of unique when compared to the commercial world. My name is Bill Walter, and I'm the managing director of the government contract consulting group here at Forvis Mazars, a relatively large accounting firm with all sorts of industries, but all I focus on is the government contracting world, dealing with FAR, CAS, and anything that kind of pulls its way into that. So today, when we're finished, hopefully you'll have a pretty high level understanding of what the purpose of cost reimbursement contracts are. We'll bust a few myths, a little bit of understanding of the life cycle of cost type contracts. One of the things about cost type contracts is administratively, they are a burden. So it takes a lot of time to be able to close these contracts out. You have a contract with McDonald's, you go in, you buy your hamburger, and you're out. You've completed the contract. It took less than 5 minutes. With a fixed price contract, you go in, place the order, you win the contract, you deliver the product or service, you get paid. Contract is done. With cost type contracts, that closeout process can take years. So a lot of administration, a lot of elements that we're going to talk about today. During that, a lot of those cost principle issues deal with the general accounting or cost accounting type elements. And then there's also a lot of it, like I said, a lot of administrative requirements. You want to start the contract, you got to prove you have this. You want to close out the contract, you want to prove you have the document that you provided that. So lots of things to go through when dealing with cost type contracts. So today we're going to talk about kind of the who, what, where, when, how of cost type contracts. We're going to talk a little bit about cost type contracts. We're going to talk about the personnel, the people who are involved in administering them. We're going to talk about what happens during performance and administration of a cost reimbursement type contract. Then, of course, what we all want, let's get paid. And we'll talk a little bit about the cost requirements. And a lot of you are familiar with the term of cost allowability, direct costs, indirect cost rates, et cetera. We're going to touch on that as we start to wind up today. And then towards the top of the hour, we're going to talk about incurred cost proposals. I apologize, it says incurred cost submission. They are incurred cost proposals, but the term incurred cost submissions is also used. We'll talk about what they are and when you need to prepare them. And then we'll talk about rates, all sorts of types of rates. And then we'll talk about closing out the contract. And then we'll head into the questions and answers. So let's jump in. We have an hour to go. If you do have questions, please, as John said, pop them in the Q&A pan. If you've been on a class that I've taught before, you know I love to take questions during the class. But for this 101 series, that's something we don't do. We got an hour to cover a lot of material. And so we'll try to collect the questions at the end and rank them and do our best to answer all the questions out there. So the purpose of a cost type contract. The government has cost type contracts. And the reason for that is if you go and ask somebody, hey, I'm a contracting officer for the US government, and I would like to buy the next generation fighter aircraft. You're going to get, and you say you want to do it on a fixed price basis. you're going to get prices from these contractors that are going to be absolutely outrageous because they're going to have to build all the potential risk into that firm fixed price. So the government uses cost type contracts when they say, hey, there's some level of uncertainty here. So the next generation airplane that comes out, when that gets set up, the current version of the next generation airplane that we're using is the F-35, and that's been out for years now. And so some of the technology in there is dated. Some of the planes that we're still flying today, the B-52s, have been around for decades. And they keep upgrading elements of them for current technologies and things like that. But it's very hard to predict how many airplanes they're going to need, how long do they have to last, et cetera. So whenever you have those sorts of uncertainties, and it can be an uncertainty about how to do something, it can be an uncertainty about how many quantities. Oftentimes, there are base operation type contracts, which is basically weeding, mowing, providing maintenance support around a military base. Well, oftentimes those are cost reimbursement type contracts or cost type because the government doesn't know what buildings are going to require maintenance. They know it's going to be painting, they know it's going to be an addition, it's going to be fixing a roof, it's going to be replacing some windows, checking on different things. But most of the time, there are a lot of uncertainties that can be associated with a contract. And if there's a contract where if you're the person who's bidding and you're looking at it and saying, wow, I don't know how many widgets we're going to need, I don't know how many hours we're going to need, et cetera, chances are the customer should be leaning towards a cost type contract because of those substantial uncertainties. Doesn't mean they will. I've seen a lot of contracts that have come out on a fixed price basis and a number of contractors willing to bid on the work. And it's like going to Las Vegas, man. They're sitting there, they're hoping that a lot of these risks don't come about and they're going to be bidding this work on fixed price. And when they win it, I've seen companies that have done really well, but I've seen other companies that come in with a lot of changes to the contract because of they say, oh, it took more hours than we thought. And you have a lot of the government people are saying, too bad, this is a fixed price contract. We didn't tell you how many machines needed to be repaired or how frequently. We just said, here's a listing of all the machines we have, and we want you to provide the maintenance on it. So when you take a look at cost type contracts, it's to help the contractor from the standpoint of you can't put too much risk on them. If you've ever had a plumber come out to your house on a weekend, they don't give you a firm fixed price. They give you a rate per hour. And once again, it's because they don't know exactly what's happening. Do they have to come out and turn off a valve? Or do they have to come out, turn off a valve and replace some pipes? Or do they have to dig a hole from the street all the way to your house? They don't know that until they get in to take a look at it. So cost type contracts, the government is saying, okay, either I don't know the exact requirements or I don't know how much is going to be needed, or we're going for the cure for the common cold. Anybody want to bid a fixed price contract on that one? I don't think so. But the concept behind a cost type contract is the government needs the work done. And they're going to they're going to select a contractor who can do the work. And the contractor is going to follow all of these very detailed administrative procedures to make sure costs charged to the contractor are allowable, that they're within funding limits, all sorts of elements that are built into that contract. So in theory, a contractor assumes virtually no cost risk. Okay, but if you take a look at court cases that come out, you're going to find that contractors do find cost risk. And we'll talk about how a lot of those things can be perceived as they go through the courts. So here, if the work cannot be completed, initially I said it would be 10 million, and I come in and I'm spending 8 million, I can reach out to the government and say, hey, looks like I'm going to need to spend another 4. So you need to find $2 million or give me some direction. So under a cost type contract, once I get to the amount of funding the government's given me, I simply stop working. And it's not as simple as that, I know, but that is how cost reimbursement contracts work. If it was a fixed price contract, you have to keep spending money, paying your payroll, paying for material costs until you deliver that product or deliver that service. With a cost type contract, you take a look at the funding level, you do your best. It's called best efforts. But at the end of the day, if you don't get the end product or the end service, you give the government your best efforts. What is it that you have at the point in time when you've spent all the money that's been set aside for that work? If there's a defect, On a fixed price contract, you, the company, has to repair the defect and give a working product back to the customer based on the terms of the contract. If it's a cost reimbursement contract, generally speaking, if there's a defect and it comes back and you have to retool or remachine something, you're going to be paid for that rework. That's how cost type contracts work. And at the bottom, the last bullet point here, if you're found to be deficient and you can't complete the work, under a termination for default on a cost reimbursement contract, you, the contractor, will actually be paid for the cost that you've incurred. Okay? Very different from a fixed price contract where you get nothing, but you may actually have to pay increased cost for somebody else to get the work done. So, a bunch of laws in place with government contracting. We all know those things. So if you have a sealed bid, which is a very competitive contract, FAR Part 14 says thou shalt not use cost type contracts. In competitive negotiations under FAR Part 15, you can use a cost plus contract, you can use a fixed price or some sort of a combination. If it's a commercial item acquisition in FAR Part 12, no cost type contracts. So the government issues a lot of commercial item contracts. They have to be fixed price. So if you're dealing in fixed price, competitively bid type contracts, or commercial item type contracts, all the stuff we're going to be talking about for the next hour will probably not be applicable to you. The DOD, the DOD, whichever one we go with these days, they did have some issues many years ago where they were trying to issue fixed price research and development contracts. The fixed price research and development contracts ran into a challenge. And one of the court cases with the A12 program, the Avenger, took, I think it was close to 30 years to get resolved in the courts with the termination for default. Well, then it got converted to a termination for convenience. And then they were trying to figure out and point fingers at who was responsible for what. 30 years later, lots of attorneys' children went to some of the finest colleges here in the US because they tried to use a fixed price contract for something that was just very broad and it couldn't be tied down, where the appropriate type of contract was more of a cost plus. So Department of Defense has put some limits in using fixed price contracts for R&D because of the uncertainty associated with it. And then you do have a contract that's called a cost plus, a percentage of cost contract, strictly prohibited, not allowed to use it. Just keep away from it no matter what you do. Some common misconceptions, some common myths is that the contractor has no cost risk. Well, that's not true. If you spend more than your funding, you're at risk. If you incur costs that are unallowable, you're at risk. If you incur costs that you don't think are unallowable, but they get challenged during an audit and you can't pass the hurdle of the auditor or the contracting officer, you're going to be at risk. Another misconception is that the government doesn't receive a deliverable. Well, they do. They receive your best efforts. You provide whatever documentation you have, whatever materials you've purchased, all of that stuff. Once you bill it under a cost type contract, it becomes the government's. So the government does get something. They may not get the deliverable that they were hoping to get in the scope of work, but they will get all of the information, all of the elements associated with what you did to try to get to that level. The thing I hear in the news with great frequency is, oh, cost plus contracts. Oh, that's just, you spend the money and the government has to pay you. That's not at all true. What we're going to talk about for the rest of today, this session, is what controls the government has in place. And there's a lot of cases where contractors would spend significant amounts of dollars and they didn't get reimbursed. So it can happen. And so understanding what your requirements are can really help you. One of the key elements to a cost type contract are two clauses, and it's a limitation of funds, limitation of costs. And whenever you hear a contracting person talk about it, they usually use both of them in the same breath. And the reason for that is these clauses are a part of a significant administrative process where you, the contractor, you have to keep your contracting officer notified of how the money is being spent on the contract. And you have to give them a notice, generally 60 days, before you reach normally 80% of the funding under the contract. And when you give them that notice, the contracting officer has to tell you if additional funding is available. And if additional funding is not available, you got to figure out, how am I going to get the work done in the next 60 days plus however long it takes me to get that last 20%. So if a contractor comes in, I see a lot of companies come in and say, hey, Bill, we put in our incurred cost proposal, and under this contract, the government owes us X millions of dollars. And I'm like, oh, okay, well, what's the funding level on the contract? And they're like, oh, we built up the ceiling, but we did the ICP, the incurred cost proposal, and it shows that our indirect rates were higher, so they owe us money. Well, they don't owe you money. You can put on your knee pads and say, hey, guys, we overspent. We'd love it if you had some additional funding that you could help us with this. We've had some companies who've had success with that. We've had companies who have found no success with that. But the funding is so critical, because that is the cap on the government's obligation to pay under a cost type contract, unless you can prove changes and all sorts of other things that require a lot of legal support. And the reason limitation of cost and funds is used in the same sentence, because it's the same percentage, it's the same notification days, 60 days before you reach 80%, 75%, whatever your contract says. The difference is a limitation of funds clause is when your contract is fully funded, and limitation of cost clause is when your contract is fully funded. Limitation of funds clause says, okay, I've got a $10 million contract. The government has initially given me funding of $1 million. The government's cap is $1 million. When they mod and add another $1 million in funding, their cap is now $2 million, even though the contract award says 10. So these elements here are very key. And if you want to avoid these problems, make sure your business processes identify what your spending is. You have processes in place to say, ooh, when we reach a certain percentage of cost against the contract, we need to let our contracting officer know. And there are other companies that will say, this customer is really important. We want to do work with them. So we'll keep spending money over the ceiling because we think they'll find more money. I don't recommend that. I've been in that situation several times. It's come out okay. But definitely a lot of risk factors that are tied directly to these clauses where a company, their contracts team, may not do what they need to do. So now, some of the key obligations of the contractor: you got to do your best to meet your contract objectives. You got to report status. How are you doing towards that? You have to report cost overruns and cost underruns. Nothing will make a contracting officer as angry as you coming and saying you need more money and they have nothing left in their checkbook. The thing that can also upset them is if you come back and say you got more money because I didn't spend everything, and then they lose that money. They can't find an alternate source for it somewhere else. There are two forms of a cost type contract, specifically cost plus fixed fee. There's a completion form, which is basically spend the money, do your best. And then there's a term form. The term form is where during the term of the contract performance, you have to provide a certain number of hours. You say you're going to provide a specific level of effort during that period. And if you fail to provide that level of effort, well, the government has a lot of options that they can do. But generally, term form is where the government says, I need you to provide, or you're going to tell me you're going to provide 5 FTE staffing positions, and they're going to be available. They're going to be my beck and call people. I can call them in whenever I want them. There's a bunch of different types of cost type contracts that are identified in FAR Part 16. There's cost sharing, where for every $2 the government pays you, you're going to contribute $1 or whatever that ratio is. There's cost reimbursement, which means you're doing the work and you're only receiving allowable costs as reimbursement. So unallowable costs, if you incur them, they're going to come out of profit. Cost plus fixed fee is a contract, as it sounds. The fee amount is determined at the time of contract award. If you spend more money and the government provides you additional funding, chances are that fixed fee will not change unless you can show that there is additional work that had to be performed. Cost plus award fee, this is you get a report card with your work. And if you get a high report card score, chances are you'll recover a part of an award fee pool. If you get an average or below, chances are you'll get no award fee. So it could almost become a cost reimbursement type contract. And then a cost plus incentive fee is where the government has some sort of incentive. I want to get this road built very quickly. So the faster you get it done, I will give you some additional fee. Or if it's if you underrun cost, we know that there's a lot of risk here. But if you can underrun your cost by a certain percentage, we'll give you an increase to your fee. But if you overrun, we'll decrease your fee. So lots of different types of contracts associated with the cost plus world. When looking at a cost type contract, if you've taken classes before, you know the government has price analysis, and cost realism. Under a cost type contract, the government will definitely do cost analysis, and they'll look at your rates and factors, et cetera, but they'll also do a cost realism analysis, making sure that the costs that you're proposing are realistic. So if you have for history, a 15% G&A rate each year, and you're proposing a 5% G&A rate on this competitive cost type contract, the government's going to take a look at that and probably say, they're proposing a rate lower than their historical average. They haven't given us a really good explanation. So they're going to increase your evaluated price to compare against the other bidders. So cost realism is making sure you're not underestimating your cost and you've identified the resources and properly costed them for your proposal. Cost realism is required for all cost type contract awards, because the government doesn't want to award a contract to somebody and then be surprised when they come back and say, oh, by the way, we need more money. When you submit your proposal in response to a contract, you're going to give the government a cost estimate. If it's over $2.5 million, yes, I said $2.5 million. If you're not paying attention, the threshold for certified cost or pricing data on October 1st was increased based on inflation to $2.5 million. The government can ask for data other than certified cost or pricing data. They can ask for information on your subcontractors, your significant subcontractors, and they're going to be testing them all for cost allowability. So if you're using a cost type contract, your price is equal to your cost plus your fee. So the government will take a look at the allowability of the cost that you've proposed. And if you have profit, okay, fixed fee, cost plus fixed fee contracts do have limitations where the fee cannot be more than 15% of the allowable cost if it's R&D, and it can't be more than 10% of any other cost type contract. I've had some clients that have come in saying, no, we're going to do cost plus work. We want to get 12%. And I'm like, well, is it R&D? No, it's just general cost plus work, but there's some risk involved. So there, it's going to be capped at 10%. FAR Part 15 identifies a bunch of guidelines associated with profit. It's not an evil thing. And it identifies, if you're in one of the agency FAR supplements, they usually have weighted guidelines. And when they do that, one of the elements is going to be cost or contract type risk. And the contract type risk factors in the weighted guidelines methods say that if you have a cost type contract, the risk associated with that factor is near zero. Okay, so let's talk about the people involved in the process. So in the process, we have ACOs, administrative contracting officers. We have auditors. And because it's a cost type contract where the price is going to be the allowable cost plus the agreed to fee, people want to make sure that the costs that you're billing are allowable. And there's lots of news stories about people who have identified that, hey, there are costs that are being charged against government contracts that shouldn't be. So FAR Part 42, the Federal Acquisition Regulation, for those of you who are familiar with it, the Part 42 deals with contract administration. FAR 42.1 talks about cognizant auditors, and it says, hey, it's DCAA. Okay, now DOD, the Department of Defense, Department of War will use DCAA. Civilian agencies can use DCAA. We're going to be talking about DCAA throughout the rest of the presentation here from the administrative standpoint, because even if you're not audited by DCAA, if your agency you're working with is not DOD, and they use an independent third-party auditor, chances are they're going to DCAA's website to be able to pick up the audit programs, the audit insight, the guidance that a DCAA auditor would use. because most of what DCAA audits is cost. If it's a price determination, contracting officers have lots of people to help them with that. But if it's a cost issue, DCAA is the recognized expert for government contracting within the channels of the government. So DCAA, if there's a cost proposal audit, if there's an incurred cost proposal audit, if there's a forward pricing rate audit, if there's a rate for an audit associated with the termination settlement or a request for equitable adjustment, if there are any number of audits, just go to DCAA's website, look at the audit programs, and there's over 100 listed. Those are the types of audits that auditors do, and almost every single one of them is tied to cost. So if you're doing commercial pricing and they bring DCAA in, think twice, push back, find out why are you bringing these guys in? They're going to want to look at cost plus profit because that's what their DNA tells them to look for. So if you want to use fixed price competitive, if you want to use commercial pricing, you've got to find other ways to help your contracting officer and his or her team do their price analysis. The administrative contracting officers in FAR 42.2 have 71 different things that are listed. So it's 42.2 something dash 71, 42.2A, and it just keeps going. All the things that the ACO is required to take care of on an administrative nature, and most of them are associated with cost type contracts. So administrative issues, cost type contracts, read through FAR Part 42, that'll talk about it. Two of the common things that we had a lot of questions on are 42.7 that deal with indirect cost rates. Not how do you calculate them, that's FAR Part 31, but helping to set them, helping to determine what do you use for bidding, what do you use for billing. All of those things are spelled out in 42.7, and they're also spelled out in 42.17. These are more the processes to do it as opposed to the, the dummy's guide to indirect cost rates. And there is a book out there, I think, that's called that. But anyhow, those are the people that are involved from the government side for oversight. A significant amount of oversight built in through the regulations. Okay, so the performance and administration side of a cost type contract. So what we have here is if you have a cost type contract, you got to have an accounting system. You're going to find changes and modifications to your contract. Inspection has to be taken care of. Defects we talked about briefly. Cost plus contracts can get terminated just as likely as a fixed price contract. And then we're going to talk about property. A lot of people to get into cost type contracts don't realize what a big element property is for a cost reimbursement type contract. Okay. Sorry about that. I kept looking askew at the screen. I got this little tiny image over here with 300 plus names next to it. So let's talk about the performance. Under a cost type contract, FAR 16.3 states that a contracting officer shall not, cannot, must not award a contract that's a cost type contract unless the contractor has an accounting system that is capable of accumulating costs under a cost type contract. So the standard form 1408 is called a pre-award survey of contractors accounting system. If you go to any of the software packages that are out there that say that they do government contract work, they all have a 1408 and they all have it marked as yes, 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 our system does this. Doesn't matter what the software says it can do. It's your internal controls around that software that really matters. So you have the standard form 1408. If you do work with the Department of Defense, you've got to understand the DoD FAR supplement or DFARS 252.242-7006. That's a clause at the tail end of the contract. You see it's 242, so we know it's contract administration. And in there, it identifies, okay, for an accounting system to be adequate for the Department of Defense, it has to meet the following criteria. And the criteria are very comparable to the 1408. In fact, a dozen of them are exactly the same. But the Department of Defense adds a couple of other criteria. So if you have a contract with the Department of Defense chances are, if it's a cost type contract, they're going to ask DCAA to come out to take a look at your accounting system unless they've done it in the past. And when they take a look at your accounting system, they're going to try to say, okay, does it do these 18 things? And you're going to say, Bill, you've only got 10 on this slide. And I'm going to tell you, you're absolutely right, because the next slide has the remaining 8. So they want to make sure that you have a sound internal control system, a judgmental determination. A lot of subjectivity about that. They want to make sure you have proper segregation of direct costs from indirect costs. They want to make sure that you can account for your direct costs by contract. Those 2 points are straight off of the 1408 verbatim. So when you take a look at these criteria, can you account for cost by project? Do you have a way of accounting for unallowable costs? Do you have a way of calculating indirect rates that is in compliance with what's in FAR Part 31 and, if applicable, the cost accounting standards? They want to make sure that you have the appropriate approvals in place. They want to make sure that you check it from time to time. They want to make sure you have timekeeping, okay? Because a lot of labor costs gets charged to government contracts, and the government wants to make sure that if you want to charge time, you have to have a timekeeping system in place that meets a lot of criteria. We actually have a 2-day class that we put on at PCI that deals directly with timekeeping. So pretty significant if you do that. DCA will test it. If you're determined to be a potential risk contractor, they will do floor checks every year. In the past, they were mandatory annual audit requirements, and they would come out and do floor checks every company every year. But since COVID, they kind of reviewed how they do those, and they're only going to do the floor checks if they feel that there's a need to. So they're doing more risk-based auditing today. The remaining criteria, they want to make sure you calculate your rates with some frequency. I recommend our clients take a look at them at a minimum of quarterly. Take a look, because if you get to the end of the year and it's like, oh, our rates are too high, it's too late. But if you look at them in the beginning of the year, in the middle of the year, you can do things to try to effectively manage your indirect cost rates so that you can try to minimize the need to go back to your customer and say, oh, I'm blowing through the budget faster than I thought I would. The criteria also says, hey, we got those limitation of funds, limitation of cost clauses here on bullet number 15. They want to make sure that you have historical accounting data so that that can be used to help determine the cost estimate and the prices for future contracts. Okay. And then they finally seal it off with CAS if applicable, GAAP if not. All right, so with your accounting system, the expectation and the focus of an auditor is going to be your books of account have to tie to whatever you say your rates are, your job cost ledgers, et cetera. They want to make sure you have an adequate job cost. And if you're a chemical manufacturer or something like that, a pharmaceutical, you probably have process costing. That's fine. You can even have standard job costing or standard process costing. Any of those are fine, so long as the controls are in place to give adequate information. The auditors will spend a good deal of time on your timekeeping system, and they'll do a lot of testing on how you take those hours and convert them into dollars to charge them to the job. They'll want to make sure that you have adequate policies and procedures in place. So if you don't have them in place, and the auditors are going to be coming either today or sometime in the future, start thinking about putting together some policies and procedures on what cost do we charge direct, what do we put in indirect, and what do our pools look like? How do we allocate them to contracts? Definitely have a procedure in place to demonstrate how you identify and segregate unallowable costs. Those are some very common expectations that the auditors are going to have when they come in. Some of the most common deficiencies that we run into with accounting systems are companies don't make monthly entries. We have a number of clients that will put their information in their shoebox. They got enough cash in the bank, and they go through and they deal with their day-to-day work. And then all of a sudden they come in at the end and they start putting information into their ledger. If you want to have an acceptable accounting system, make sure that you're entering data at least monthly. Some companies don't segregate direct and indirect costs. They put all the salary and wages into a single general ledger account in the books. That can be very difficult for an auditor to say, well, how much was associated with this termination over here and how much was associated with this contract over here? If the auditors can't determine readily what they are, they'll identify them all as direct cost and calculate your rates that way, which will cause your rates to be significantly lower, not realistic, but lower. Uh, Timekeeping, the auditors will look for improper timekeeping. When I was raised as an auditor in DCA back in the 1980s, a long time ago, we were trained on looking for people who were working on fixed price work that all of a sudden are charging to cost plus work, because that's the real risk in timekeeping, is somebody charging time to a job that is not the one that they're actually working on. So with improper timekeeping, it's kind of converted to many things today. And I've seen a lot of people who come in and say, well, improper timekeeping, you didn't use the right color ink, you didn't get the right approval, you filled it out 2 days late. Those are all indicators of internal controls over your timekeeping. But those are things where an auditor, if they don't believe that you have adequate controls over your timekeeping, they can say, we don't think you have an acceptable accounting system. And companies that don't address unallowable costs at the point of data entry, oftentimes the auditors will take a look at those and say, we think you have a system deficiency here. And if you do have unallowable direct travel or unallowable direct costs, the auditors are going to want to see those costs included in the base for allocating G&A. Be careful, this trips some people up. I've seen many auditors come in and say, well, wait a minute, you have interest expense and you've pulled that out of your G&A pool. Well, the regulations require that to be in your base for G&A. No, that's not what it says. What it says is an unallowable cost should be included in the base if it would have been there had it not been an unallowable cost. So if I have travel that's over, or labor that's over the funding on a contract, I have to charge it to the contract, even if I don't get reimbursed for it, because it's not allocable anywhere else. Okay. If you do have modifications to a cost plus contract, if it's an authorized unilateral change, the government can give you an increase in your estimated cost that's associated with the contract. They can give you more time on your schedule. They can give you additional fee because they've added scope to the contract. And they can change other terms and conditions in the contract. However, I have a slide out of place here, so I'm going to skip to the next one. If the government is simply, actually, no, I was on the right one. Sorry. If the government has to put more money in your contract simply because your estimate was understated, they may give you additional cost, but they will not give you additional fee. Your fixed fee will not change unless there was a change to the scope of work. With funding, there's not a lot of FAR coverage on it. It's located in FAR Part 32.7, but the government can add money to your contract, and they don't need the agreement of the contractor to do it, but they can also take money away from your contract. But that generally will require a bilateral agreement, meaning you have to agree to it as well. I've seen a lot of cases where contracting officers take money off a contract, but the true up to the indirect rate, some outstanding bills that haven't processed through yet or have already been incurred by the contractor. So that funding was already earmarked because the contractor had already spent it. It just didn't show up through the billings, et cetera. So if they want to add money, they don't need your permission. If they want to take away money, they do. To be able to fund a change to a contract, they, as I said, they can delete money. If they do that, it should require the contractors, your agreement when you go through. And a constructive change. That's something that may not be associated with a formal modification, but it can be an informal change to the statement of work. Yeah, we want you to inspect it 3 times, not just the one that you included in your proposal. Okay, now I have additional steps that I have to take. They should be made by an authorized person. If they're made by an unauthorized person, it may be a little bit of struggle administratively to get it taken care of. Oftentimes they can be unintentional. If it does cause a cost growth, then the contractor is going to be able to, should be able to get those costs covered if you follow all the rules. And you may actually be entitled to fee on that. But whatever you do, if it's a constructive change, your changes clause says, hey, you have to notify the customer. For quality assurance, the inspection and acceptance, the contractor under cost type contract has to provide and maintain an inspection system. If you get supplies and services, you have to be able to make sure that you can you have a system that tracks them. You also tell the government, we're going to give you access to our quality records. You give us the contract, you get access to it. And if there's a defect that needs to be corrected, we'll do it. But if I have to spend 6 hours doing it, that's going to be allowable cost on my contract. The government has the right, not the duty, to inspect. You have to make it available. They're going to take a look at things, but they don't always get out to inspect every item that goes out. If you do have defects under a supply or an R&D contract, you've got 6 months after the item is delivered where you have to continue to fix it. If they're correctable, you can get it corrected. You'll be paid for the cost. And if it's an overrun, and you go in for an adjustment to your contract and say, hey, why are you going to overrun? Well, we had this rework. They won't give you additional fee on the rework. And if you can't fix it, then the government can adjust your fee. They can't reduce your cost, but they can reduce your fee. I said they shouldn't reduce your cost, but they can reduce your fee. Contracts get terminated. We all heard about DOGE earlier this year. And if a contract is terminated, if it's a cost reimbursement contract, there's a clause in your contract, 52-249-9, that says that in the event of a contract termination, you're going to spend the next 6 months billing out the costs that you've already incurred. So whatever costs were incurred up to the date of termination, you place purchase orders, you have material coming in, you've got payroll that gets paid 2 weeks later. All of those costs will hit your books, they'll hit your job costs, and you can bill the government. You have to settle with your subcontractors. You may have a settlement proposal cost that you have to put together. Then it could be an outside accountant like us. It could be an outside law firm. It could be your own G&A people who are now doing something different. And they can track those costs and they can be chargeable direct to the termination as settlement proposal costs. And you may have a bunch of materials and supplies. Hey, we've got to keep these materials and supplies running over here. So let's keep our customer informed about how long that's going to take. And at the end of the day, if you get 50% of the work done, you're going to get 50% of your fixed fee. If you get 80% of your work done, you get 80% of the fixed fee that was agreed to under the contract. I said this earlier, under a default termination, you're going to be able to recover your costs. You'll be able to receive a piece of the fee for any work that was accepted. So if no work was accepted, then you won't get any portion of your fee. Unlike a fixed price contract, the government cannot come back and say, you're going to, sorry, that just popped up on my screen, John. With a fixed price contract, if the government has to find somebody else to do it and it costs the government more, they can come back to you under a fixed price contract and say, here's our excess reprocurement cost to get this work done. And if that's the case, the contractor can be liable for those additional costs. I said property is one of the big elements of a cost type contract, and it is. If you bill the government for a computer, that computer is now government property. So anything that you buy under a cost reimbursement contract, anything that you buy and bill to the government becomes government property. So if you have a cost plus contract or a cost type contract, you have to have a very good property system in place. There's a whole part of the FAR that's associated with just government property. And in there, you have to maintain a property control system. If you got this property, you want to use it on another contract, you got to get permission from your customer. All of these elements are required, and you've got an annual reporting requirement. In the event of a termination, you got to fill in the forms. You want to close the contract out, you got to give the government a listing of all the property that was purchased under the contract so that you can await disposal directions. So property under a cost type contract, it's more than just rates and billing. It's also, now I'm buying contractor acquired government furnished property. So I issue a PO, I buy it, and I've had clients who've had computer workstations in the basement of their building and they didn't know what to do with them. And we're like, you got to fill in the forms and you got to get it to your customer so that they can give you disposition requirements so that you can reclaim that space and use it. Okay, so the next 15 minutes, we want to talk about allowable cost and payment, invoice, and some of the cost accounting rules. We're not going to get into too much detail here, but there's a clause in all cost type contracts, should be, that's called allowable cost and payment, and that's at FAR 52.216-7. It tells you how to bill, the forms to use. You can invoice a couple of times a month, every 2 weeks. You can get your allowable costs reimbursed. If you are using provisional indirect rates, it'll tell you how to get your final indirect rates. It gives you the requirements for an incurred cost proposal. So if you ever hear DCAA or somebody say, where's your incurred cost proposal? Go back and look at your contracts and make sure that you have a requirement to provide it, because it's really only for cost reimbursement type contracts. The basic rules that govern the cost allocations are in FAR Part 31, the cost principles, and that says what's a cost, what's a direct cost, what's an indirect cost, and is the cost allowable or not. So all of those questions can generally be answered by going through FAR Part 31 or understanding how it's been interpreted over the years. There's several books out there that are available on that, and there's a lot of people like me in industry who understand these rules, because that's all I've worked with my whole career. And then if you're a large business and if you're working on cost type contracts, chances are if you have a contract that's going to be awarded over $2.5 million, you're going to have that contract subject to the cost accounting standards. So these cost accounting standards are 19 rules, soon to be 15. There are 4 that are kind of being proposed to be pushed out of the rule, and then the contractors are just going to follow GAAP. But the cost accounting standards require consistency from your bid to your accounting for the contract. They require consistency from one period to the next. So you want to change how you compute rates. You want to change how you assign cost to contracts. If you're subject to CAS, you have some extra steps of administration to be able to take care of. And you may have a requirement, if it's over 50 million, to provide a disclosure statement. That's a specific document that's associated with CAS. So if you're a small business, your customer wants a disclosure statement, give them the Heisman. Nope, we don't have any contract subject to CAS. Therefore, we don't have a disclosure statement required. Understand what's applicable and what's not. Direct costs are identified in FAR 31.202. And basically, if it benefits one and only one contract, that cost can be charged direct to that contract. And any other cost that's incurred in like circumstances has to be charged to the contract that it benefits as well. So FAR 31.202, Cost Accounting Standard 402, they have a lot of similar requirements. The difference is the Cost Accounting Standards has some statutory guidance that's associated with helping to try to make sure you do the right thing. Then we have indirect costs. And an indirect cost is basically the cost that you can't charge direct, and you pool them into overhead or into G&A. And you got to make sure that you treat your costs consistently from one period to the next and things like that. Here we also have that if it was indirect when you bid, it has to be indirect during performance, unless you go through some administrative requirements to get that changed. So setting up pools, setting up what my direct costs are pretty big elements of administration. It's not something that you can willy-nilly change because you want to try to recover more costs, or in many cases, you want to try to be more beneficial to your client. Cost allowability, 5-part test. Somebody comes to me and says, Bill, is this cost allowable? I immediately go say, well, is it reasonable? Is it allocable to the contract? Does it meet the standards of CAS if applicable? Is there a term of the contract that says you can't bill that cost? Or is it something that's listed in FAR 31.205? So this is something we spend 2 days on a class going through all the details of this. So if you do a contract, these are the specific challenges that you went into with your auditors. So we have a contract life cycle. We hear these things about rates all the time. So I have forward pricing rates. I have billing rates. I have actual rates. Okay, well, my forward pricing rates is how I set my overheads and my G&As and calculate them for purposes of preparing a bid, hence forward pricing. What do I think it's going to be in the future? Billing rates, provisional billing rates, are what I'm using to bill on my contracts today. It's the same pools and bases, but in the forecast, I'm looking at future years' projections. In terms of billing rates, I'm taking a look at my best estimate for this year. It could be the same as my forward pricing rate at the beginning of the year, but midway through the year, I have half a year of actuals. I can do some assessments, and maybe I need to adjust what I bill on these contracts. And then I have actual rates. That gets into the incurred cost proposal that we're going to hit very quickly. Understanding indirect rates, you really need to understand your cost accounting practices. What do I capitalize? What do I depreciate? And be careful about R&D. A lot of people hit me up this year because they were capitalizing R&D for tax purposes. Okay, well, that's not a GAAP purpose, that's a tax purpose. So if you capitalized a bunch of IR&D, talk to your accountant, talk to me, because that's not for government contract accounting purposes. Take a look at the allowability of costs. It's that 5-part test. It's very important to understand that. Okay. The last thing we want to talk about before we get into some question and answers is incurred cost proposals. So what is an incurred cost proposal? Okay. So I mentioned this clause earlier, 52216-7. And 52216-7 says that, okay, we're awarding you this contract. And by awarding you this contract, you agree that 6 months after the end of your fiscal year, you will send us a summary of your indirect rates. And you'll tell us what your actual indirect rates are. And we'll compare them to what you provisionally billed. And if you provisionally build rates that are lower than your actuals, if there's funding available on the contract, you can true up your billings and you can collect a little bit more cash. On the other hand, if your rates are higher than you provisionally billed and you don't have funding, before anybody can pay you, they have to see if they're willing or able to give you some additional funding. So as a contractor, you have an obligation to submit an incurred cost proposal. Some people call it an ICS. Some people call it an ICP. It's the same document. And basically what this is a recap of when I put together my budget for the contract and I came up with my cost estimate. I said I have a fringe benefit rate, I have an overhead rate, and I have a G&A rate. And you gave your best guess as to what those rates were at the time of the contract award, and that's used to set up the funding. The next part is during contract performance, you're going to bill the government every 2 weeks for the cost that you've incurred. And as you do that, you're allowed to bill your provisional indirect rates. This is what I think my indirect rate is going to be based on more current available information at the end of this year. And if you think your rates are going to be higher than you proposed, then you need to let your customer know and start billing so that you can figure out where you stand. If your rates are going to be lower, you need to do the same thing. Either figure out how to spend more money that can help you grow and help you do things, or go to your customer and say, look, we thought we'd be billing at about a 1.8 multiple, but we're actually at about a 1.65 multiple. So that means there's going to be $1.2 million left over in this contract at the end of this year. Okay. So basically what these are my actuals for the year. So when it comes to the end of the year and you've got to put together your incurred cost proposal to the government, it has to go in by June 30th if you're a fiscal year, calendar year contractor. We have some clients that have a January 1st fiscal year, and we have some clients that have a September 30th fiscal year. So if you're a September 30th fiscal year, March is going to be your busy month, because that's when you're going to be putting together all of your incurred cost proposals. You get 6 months. When I started out, you had 180 days. No, I'm sorry. I think you had a full year, but they cut it to 180 days. So you basically have 6 months to get it into the government. If you don't get your incurred cost proposal in a timely manner, the auditor can look at that as a potential risk of your accounting system. So you want to make sure that you get that in as quickly as possible. So the incurred cost proposal has a specified format. About 10 years ago, there was no specified format. There was a recommended format from DCAA. DCAA had this thing called an ICE model that we're going to talk about in just a second. And the ICE model basically said, here's all these schedules that you need to have for your incurred cost submission proposal so that we can audit it. And as a result of that, it kind of became a standard within the industry. There were a lot of exceptions, but for the most part, people would follow the standard DCA format. Why would they follow the format? Because it's what's out there. It's what people are accustomed to. So that's what they're accustomed to seeing. Why make it a big challenge? So anyhow, when you put together your ICP, you should have a plan, just like it's a project. You know, the due date is June 30th. So you want to make sure that you can work backwards. And when do we have to get the general ledger details? When do we have to get the job cost details? When do we have to make sure we've got all of our unallowable costs vetted through and combed? When do we have to take a look at the funding schedules to see where we stand? All of that should be built into your plan. You should have milestone dates and those types of things. Okay. The DCAA ICE model. This is something that DCAA has on their website. So if you go to www.dcaa.mil, when you take a look at it, DCAA will have their ICE model, incurred cost electronic. It's basically a big Excel spreadsheet. And it's a big Excel spreadsheet. They've got lots of pretty dynamic links to it that if you put your data in the right way, it can pull it in and it can sift it and sort it and basically prepare the package for you. I've had some clients that have done that. They didn't do a lot of quality review, and at the end of the day, not everything came in the way they thought it would. So it's on the DCA website. I'm very clear to say it's an aid to the contractor. Nothing says you have to use the model. The schedules, the format are pretty straightforward. So it's not a bad thing to use. And so it's not mandatory. If you're a contractor, you can develop your own template following these same requirements. So now, when we take a look at those requirements, the DCAA ICE, their incurred cost electronic, used to have these standard forms, schedules A to G. A is a summary of all your pools and bases in your rate. So if a DCAA auditor looks at the first page, they can see what your fringe, your overhead, and your G&A rate is just by looking at Schedule A. If I go to Schedule B, it's a detail of your general and administrative expense pool. If I go to C, it's your overhead expense pools. If I go to D, it's if you have any facilities type costs. So these are very structured, organized ways to put your incurred cost proposal together at the end of the year. And these are basically built on your trial balance detail. And these first few schedules are all about pools and bases and tying into the general ledger. If you have any of the software packages that do government contracting work, they will probably have something called a statement of indirect or indirect rate calculation schedules. They're going to be pretty similar to schedules A, B, C, and D. And a lot of companies will actually have it to where you can pull those schedules out of your system. Schedule H is if you're a small business, it's probably got about 10 to 15 rows. If you're a large business, it may have thousands of rows because every contract that you have that is flexibly priced, meaning it's cost reimbursement, it's time and materials, and it has the allowable cost of payment clause built into it, those schedules will list for every task delivery order, every funding element that you have. It will identify my direct labor costs, my direct material costs, any other direct costs that you have will be in the columns. And then it applies those indirect rates that were calculated up on Schedule A to the direct labor, to the total cost input, to the material subcontract costs, et cetera. So basically, Schedule H is a detailed recap of all of your jobs, truing up provisional rates to actuals. It tells you these are my actual costs at the end of the year. Schedule I is kind of a recap. It says, okay, here's how much I've billed in the past. Here's what my actual costs were 2 years ago, my actual cost last year, my actual cost this year. And you can compare and see how much you billed and how much your actual costs are so that you know if you're ahead or behind. And if you do your accounting properly, then chances are, you evaluate it each year, chances are you're going to be okay with that. Schedule J is a listing of all of your flexibly priced subcontracts, but if you look at it today, a lot of auditors want to see all of your subcontracts. So they want all the numbers on Schedule J to tie to Schedule H. A lot of administrative effort, a lot of cost and effort companies have to go through. If you have T&M contracts, everyone is going to have its own Schedule K that ties between the direct labor hours charged and the direct labor rates included in the contract. Schedule L and M are administrative in nature. L is a very complex schedule that ties your labor cost back to your wages that you reported to the Social Security Administration and the IRS. Schedule O is a listing of all the contracts that are complete so that we can close them out. Okay. Basically, with your incurred cost proposal, you have 6 months to put it in. DCA today has 2 months to look at it and say it's adequate or it's not adequate. If it's not adequate, they send it back to you. And then you have to fix the inadequacies and resubmit it, and then the clock starts again. They have 60 days to tell you if it's adequate or not. Once they tell you it's adequate, they have to go through and audit it or dispose of it within a year. So 5-10 years ago, DCA didn't have this in place, and sometimes incurred cost submissions would go on for 7, 8, 9 years before DCA had time to audit it. That all stopped in 2018 when Congress said, DCA, you've got to get this together. You can't keep stringing contractors along. 60 days to approve, and if you approve it in 2 months, you have 10 months to complete the audit or close out the rates for an audit determined rate. Okay. Let me see. Yeah, we got a couple minutes here. So a lot of questions that we see that companies need to look as before you submit your incurred cost proposal to the auditors is take a look and make sure that you've got all of your unallowable costs identified. Executive compensation is always an issue in cost allowability, making sure that you're not including costs that would be unallowable based on caps, things like that. Take a look at bonuses, make sure you've got the right documentation associated with them. DCA does take a look at marketing and legal expenses. They'll take a look at subcontract costs to make sure that they're fair and reasonable. So a lot of the things that you see up here in the screen are the types of things that the auditors will take a look at during the time that they're reviewing your incurred cost proposal. With a fixed price contract, just like at McDonald's, you buy your McDonald's hamburger, they give you the McDonald's hamburger, they give you a receipt after you give them your cash or your credit card, you sit down and eat it, your contract is done. You went from start to finish very quickly. If you're buying supplies, parts, things like that, same thing. Very quick. When you know what you're ordering, you can order it commercially, you can order it competitively, you can get those things, and once you receive it, you close out the contract. If it's a cost type contract, the time standards on this are 36 months. And so the regulation says, okay, if you have a cost type contract, it's going to take some time because you have to get the incurred cost proposal in. Funding has to be realigned. If you have property, you have to close out the property. If you have inventions, you have to get all of these things closed out. So here's a 15-part check that identifies the 15 things that have to be documented before you can close out a cost reimbursement type contract. Okay, so if you have any classified material, has the DD 254 been closed out? Has it been cleared? Submitted. Are there any value engineering change proposals? Property clearance. So you've got to have all your forms together. It says, here's all the equipment, here's all the materials, here's everything we bought that is government property. You got to figure out what you want to do with it. The prime has to settle all the contracts. At the end of the day, the contractor has to submit an invoice that's marked final that tells the payment office that this is the last cost plus invoice we're going to get on this contract. And when they do that, there are closing statements, there are releases of claims, they go with that final package. So a lot of administrative effort to make sure that everything that's included in all those provisions of a cost type contract are cleared out at the end of the day. And at the end of the day, the government looks at the funding authorized versus the funding that was collected by the client, the contractor, including the final invoice, and that's the final send off, is tying everything to actual costs. Okay, so with that, John, do we have some questions? We got about 5-6 minutes for questions before we run into our review questions.
Sure, hit the raise hand button if you want to ask a question.
There's 300 of you on here, so somebody should have a question.
All right, Elizabeth, you have control of your mic.
Okay, Elizabeth, you can click off your mute button.
Or toss your question in the Q&A or chat. Either one is fine too if you don't have a mic. But you do have control of your mic, so you have to hit the you have to unmute yourself.
Okay, well, if we don't have a lot of, okay, so Kelly has asked a question in the Q&A, and she says, are cost overruns on cost plus contracts subject to TINA? The answer is generally not. A cost overrun where you're requesting additional funding under a contract, it's not going to be subject to TINA because it's going to be subject to all of the other audits. There's no additional fee that's coming in if it's an overrun. So as a result of that, there's a specific exemption within the FAR that says if you're simply trying to request more money under a cost type contract, it's not going to be subject to TINA, but it will be subject to final closeout, audit, all of these other requirements. Whereas if you came up with an estimate and said, hey, I've got an estimate of 10 million, and that's what your fee is based on, that's what the Truth in Negotiations Act is really trying to focus on, is making sure that the contractor has all of the same facts that you as a contractor have. So excellent question, and we don't get that one too often, but thank you for that. And then, okay, Elizabeth says she couldn't get her mic on, so we're cool. For all this admin paperwork that has to be done, can the contractor bill against that, or is it a business expense they absorb? Well, it's a great question, Elizabeth. Most companies will take that cost and include it in their overhead or their G&A rate. Now, if there's requirements that have to be done by contracts people or accountants that are on a project, oftentimes those companies will keep those individuals charging direct to the contract. So it really is going to be based on the specifics of your company. And if all of this administrative work is done by somebody that's at the corporate headquarters, chances are it's going to be in a G&A pool. If you're a decentralized organization and you push all of these responsibilities down to the people actually working on the projects, chances are it would be included as a direct cost or maybe an overhead cost. But it's something that I can't tell you this is how it has to be done. I can simply tell you that most companies will treat a lot of these administrative requirements for indirect rates, provisional billing rates as a G&A expense. Whereas the contract closeout, the contract administration, the contract modifications are oftentimes done by somebody who is actually charging direct to a contract. So you've got a lot of flexibility, and it's going to depend on your contract mix and how you'd like to do it. Okay, and James asks, are cost type contracts completely unallowable for commercial items, or is it just strongly discouraged? James, FAR Part 12 says, you can't use a cost type contract for a commercial contract. And the reason for that is you don't have cost type contracts in the commercial marketplace. In the commercial marketplace, you generally have fixed price contracts. So if the contracting officer is going to evaluate a price that's fair and reasonable, they can do that with the contract. Let me see. So, and then Blessy, last question we're going to take today. Asks, does a T&M contract need final rates before you can close it? And once again, it's going to depend on how your contract is written. So if you put general and administrative expenses on your on your materials costs, then chances are you're going to need to have that final rates before you can submit it, because you're provisionally billing a rate of X and your actual rate can be Y. So if you are not billing an indirect rate on top of your M's, if you're just billing your M's as a direct straight bill cost, chances are you don't need to wait for final rates. If you have an agreed to rate in your contract that says, hey, we're going to do M plus 10%, we don't see that too often. Some people say it's a cost plus percentage cost contract. We'll bring attorneys in to help discuss that. But if you have a markup that's built on top of your indirects that can't change with a closeout, then there's really not a need to do the final closeout. But your labor rates, those do not need a incurred cost. In fact, those rates are fixed at the time that they're determined and put in the contract. So for those, you don't have to worry about trying to close out the same way you would a cost type contract, but you still have to go through all those 15 steps. So they still have to make sure all the hours are billed properly, et cetera, when you go through. Okay, so with that, John, are we ready to go through our review questions?
Yes, sir.
Okay, so the first question I have for y'all is, what must a contractor deliver under a cost type contract? So John, people are going to get a poll that's going to pop up. There it is. Okay. So do you have to submit a complete product or service? Do you have to do your best efforts? Do you have to provide leading edge solutions? Or do you have to provide hefty reports? Okay. So when you get that, go ahead and answer. John, do I see the results anywhere? I see 80 people, 90 people.
Yep. You should be able to see the results. If for whatever reason you can't interact with the poll, you will need to put your answer in the chat.
Okay. I see a lot of people are putting the answer B in the chat, which is the correct answer. Best efforts is all you need to provide. Okay. So we're ready to go on to question number 2, John.
Yes, sir.
All right. Question number 2. The labor cost of a person performing work required under a cost type contract would generally be treated as a direct cost, as an overhead cost, as an unallowable cost, or as a G&A cost. And the term here is generally, because I'm not trying to trick anybody up, but if somebody's doing work that's required under a contract, what do you think? Okay. Okay, and maybe because I'm an organizer or something, John, it's not giving me the total of responses, but I looked through all the answers in the chat and it looks like everybody's popping in A.
Yes.
Okay? And A is the correct answer. That would be a direct cost, but a lot of flexibility with how you want to charge your costs. So it doesn't mean that's how it's going to be all the time, but you have to be consistent. Okay, our third review question is, an acceptable accounting system is required for a cost type contract. Is this true or is this false? Okay, so, and this is, James asked a good question before with a cost reimbursement, commercial contracts. Can I or can't I? Okay, so this is a definitive. An acceptable accounting system is required for a cost type contract. Is that true or is that false? Okay, I see a lot of A's and trues. So it looks like people were paying attention there as well. So that's fantastic. And that is, of course, the correct answer. FAR Part 16.3 specifically states that a contracting officer cannot award a cost type contract unless the company has an acceptable accounting system. They don't need a DCA audit. They don't need a third-party CPA audit, but the contracting officer has to make a determination. Okay. So our final question for the day, at least my final question, I think John has one more final question coming in. And this is, an incurred cost proposal is required, A, for anybody that's awarded a government contract, B, for any contract that includes FAR 31.205-7, C, to determine final rates, and D, both B and C. Okay. A bunch of people are scratching their heads on this one. There's a little bit of a tricky part to this. Okay, but I see a lot of people are popping in D. Which is both B and C. A couple of people popped in B. And I'll tell you that when I wrote this, I was thinking D, but as I reread it today, I would accept both B and D. So the incurred cost proposal is required by FAR 31.205-7, and it is for the purpose of determining final rates. So that's why I would accept both D as well as B. But if we wanted to get technical, you don't need it to determine final rates. I can calculate final rates and go through an audit without submitting an entire ICP. So both B and D, when I looked at it, and I evaluated it, I said, okay, that's where we go. Okay, so with that, John, I see we're at 2:15. Do you want to put up your last question? I don't need review question number 5. I was going to go to yours to close out the session.
Yes, sir. Please tell us how we did today. We hope we did well, but if we didn't, we would like to know. In addition to that, during the program today, we would like to know in the chat what other topics you would like to see PCI run. What other topics do we need to run? All right. And this is our first time, or our second time really, using Teams webinar. So if you have any strong feelings about how this went today, go ahead and send me, John at publiccontractinginstitute.com, a note telling me how you think the program went with Teams versus GoTo. If you're a regular at PCI, I'd like to know.
Okay, I like Ken's view. The overhaul. Thank you, Kasia. Appreciate your note. Okay. All right, Kelly, you think we have one there? All right, John, it looks like you're still getting some good answers.
Yeah. All right. I'll just leave this open for just a few more moments, but I will close the program in about 10 more seconds.
All right. Thank you, everybody. Thank you, John. Talk to you all soon.